We are continuing with Strategy 2 of how to join the 2% Club, Part 2 of Strategies that Build Your Wealth. We're going to talk about why owner-occupied real estate is one of the most powerful wealth-building tax strategies that any business owner can use. If you recall, we told you that your small business value is worth a multiple of 3 to 5 times cash flow. If you buy a piece of owner-occupied real estate, move your business into the real estate, and start paying yourself rent into that real estate, the real estate then has a net profit, and real estate generally sells for 12 times its cash flow earnings. So when you convert cash flows in your business to cash flows in real estate, those cash flows go from being worth 3 to 5 times cash flow to being worth 12 times cash flow. Over time, as the rent goes up and as the profit in the real estate grows, it grows at 12 times. Whereas that same cash flow trapped in your small business would only grow at 3 to 5 times in value. So for that reason, owner-occupied real estate is a great wealth building tool. But that's not where it stops. A great strategy to use is to buy the owner-occupied real estate, occupy it during the life of your business, paying the maximum fair market value of rents that are allowed. Now that fair market value is confirmed during the course of the valuation with a rent analysis that can support what you're paying. But then, when you go to sell your business, you can lock in a lease with the buyer where the buyer remains in the real estate and you continue to get the benefit stream of the cash flow out of the real estate while they manage and run the business that's there. And so you get perpetuity from that business in terms of rent income. Another great benefit of owner-occupied real estate is that most of the time when you go to buy owner-occupied real estate, you've established a fairly successful business that's generating excess investable cash flow, enough so that you can invest outside your business and buy real estate to put your business in. But at that point, your taxes in your business could be fairly substantial. But when you buy real estate, you're able to allocate the cost of personal property and real estate property. And that personal property, for instance, carpet is a 7-year asset in a business. A parking lot has a 15-year asset. Communications equipment and desks can be 5-year assets and other things that may come with that real estate. In the valuation process, we do asset appraisals and we identify the value of the personal property that comes with the real estate. We take a portion of the purchase cost and allocate it to that personal property. That personal property then can be deducted, even Section 179 expensed, for an immediate deduction which creates substantial tax savings. But it's not the same as when you had to pay for all that equipment and expense it when you had to pay cash for all of it, because you've got a piece of real estate that's worth what it was when you bought it and is appreciating over time. So you're getting tax deductions without losing any wealth, and that's a huge, huge plus. So in the end, when you have an inflation-adjusted appreciating asset that provides perpetuity and tax benefits, it's one of the most powerful wealth-building tools that you'll find. Some people will argue that real estate hasn't always been such a good investment, but you'll find that successful members of the 2% Club buy real estate with a substantial down payment and that successful members are not highly leveraged, meaning they don't have a lot of debt associated with their real estate. We'll get into more about this in strategy number 3, developing investments outside your business. Successful members of the 2% Club also only buy real estate knowing that it's a long-term investment and don't plan on selling any sooner than at least 10 years. So, if you take the perspective that you're going to own that real estate for more than 10 years and you don't have a substantial over-leveraged asset, meaning too much debt for the cash flows, you've saved up money and made a substantial down payment on that investment, it will turn out to be a good one for you. So let's move on to our next case study, which is a tax strategy. In this particular case, compensation planning was the key. Here, we had a sole proprietor who had $150,000 of annual profits. The business was the kind of business where a reasonable wage for this owner was $50,000. Now, during the course of evaluation, we do a reasonable wage analysis, the very same analysis that the IRS uses to establish what a reasonable wage for an owner is. We do this so that you'll have an accurate wage for this position. Again, a reasonable wage for this owner was $50,000. So the tax strategy was, if we converted him from an S corporation and paid a reasonable wage, then we would reduce his Social Security taxable income to $50,000, and the remaining $100,000 would pass through without Social Security tax. Now, the result of this compensation planning and the switch to an S corporation was that it created an annual tax savings of $8,000. If you take, in this particular owner's case, he had 20 years before he was going to retire, and so $8,000 a year invested in the S&P at 7% return, it's going to come up roughly with a $250,000 future value to his retirement. Now there's a tax strategy that builds your wealth. Let's go on to the next one, entity selection. In this case study, we came across a C corporation, and all C corporations are subject to double taxation. The corporation pays a tax to the IRS, and then as the individual gets paid dividends, they pay another tax to the IRS. So it's called double taxation. However, for an S corporation, it has a single layer of taxation. All the profit in the corporation is not taxed at the corporate level. It's only taxed at the personal level. So there's one layer of tax. Taxes are almost always the biggest expense of any investment. So by converting to an S corporation, we were able to reduce his total tax expense, thereby increasing his cash flows and making the investment value better. The other benefit was that when you convert from a C corporation to an S corporation and you wait a 10-year period, any gain on the sale of that business that was present at the time of the conversion is no longer subject to double taxation. However, if you sell within the 10-year period, the value of the business at the conversion date over the tax basis in those assets is still subject to double taxation. That's if you sell within a 10-year period. But if you wait beyond that 10-year period and then sell your business, you only experience a single layer of tax on that sale. So, we were able to eliminate a future built-in gain tax, assuming that the owner would wait more than 10 years. But it doesn't stop there. It gets better. As an example, if we do a business valuation at the date of conversion and the C Corp's value is $100,000, and in 5 years the C Corp has been an S Corp, it grows to a $1 million value and it's sold at the end of that 5-year period. Because we did a valuation and established the value of that business at the conversion, they only pay the capital gain on the $100,000 value rather than the other $900,000 that grew within the S corporation. Another benefit on how you use your valuation and tax strategies that build your wealth. Now let's look at a third case study. In this particular case, it was a cash versus accrual situation. In 2001, the IRS required businesses that had more than $1 million in sales to be on the accrual basis. However, since 2017, under the Tax Cuts and Jobs Act, the threshold for small businesses to be exempt from the requirement was increased to $25 million. But a lot of people missed the opportunity to convert from accrual to cash, lower their income, and get a substantial refund. In this particular case, the company had $8 million in gross sales. They had $800,000 in receivable, which on the accrual basis was included in income, but on the cash basis, they hadn't been paid yet. And it was not to be included in income on the cash basis. And they had zero payables because the business owner was fairly wealthy and on his way to becoming a member of the 2% Club. He had no debt in his business. So the result of converting this business owner from cash to accrual was that it created a tax refund of $220,000. As a side note, this owner was just getting ready to sell his business in a stock sale to someone, and had that sale taken place before the refund had been issued, the benefit of that refund would have passed to the buyer, and the buyer could have gone and applied for a conversion and the refund. So another great tax strategy that'll help build your wealth, adding that $220,000 to that business owner's investment portfolio, was a substantial increase. The next strategy is cost allocation, and we mentioned this briefly when we talked about owner-occupied real estate. In this particular case, the business owner had a $1.2 million piece of real estate that they had purchased 3 years earlier. An asset valuation as part of the business valuation process showed that 20% of the purchase cost of that real estate could be allocated to personal property and deducted on an accelerated depreciation basis. So we went back and amended 3 years' tax returns to show that out of the purchase cost, 20% was personal property. That created increased depreciation deductions and created a tax refund of $75,000 for that owner. Again, valuations can produce many benefits and tax strategies that build your wealth. If you have any questions related to exit strategies or your particular situation, please contact us. Join us for developing investments outside your business and strategy number 3 of how to join the 2% Club.